Hi, this is Nancy with Lock Rate Mortgage, and this is your Fast Mortgage Insight. Today I'm going to share with you some tips about appraisals, whether you're purchasing or refinancing a home. But first, let me address what is an appraisal. An appraisal is a third-party opinion of what a specific property's marketable value is on a given date. In most cases, when financing is required on a home loan, the lender wants to know how much the property's estimated value is in the current market to evaluate risks. Meaning, if you're going to ask to borrow $500,000, is the home even worth more than that? So that way, in case you default on the mortgage note, will they be able to sell your home and make back the money you borrowed? Sometimes in a purchase where you're downing more than 40 to 50% of the value of the home, they may even waive the appraisal requirement since there's more than enough equity to evaluate that risk up front. Now in today's market, where the sales price has been very competitive, we've been running into more and more scenarios where buyers are offering way more than asking price just to outbid others and get into the home. It hasn't been uncommon to see listing prices starting at $750,000 and it ends up being sold for $50,000 to $100,000 over ask. But what does that translate to aside from the fact that you just bought a Toyota at the same price you would have paid for a Mercedes-Benz? So you've chosen to buy a home for more than what it's worth. But the lender will only want to lend money on the appraised market value. Therefore, you either have to come in with more cash to cover the difference in what the home appraised for from the sales price, or you'll have to raise the loan amount to cover that difference. First thing you have to keep in mind is that sellers usually start with doing homework before they listed their home for sale to have a general idea of what the home would probably be worth in the market already. Let's use our scenario from earlier as an example for a home that was listed for $750,000. Say you offer $50,000 over asking price and the offer gets accepted at $800,000. Congratulations. You were planning to down 20%, that's $160,000, and you're applying for a mortgage loan for $640,000. That is 80% loan to value. The appraisal comes back and it shows that the market value is only worth $750,000. Remember, as I mentioned earlier, lenders only want to lend money based on the appraised market value, not the sales price. In that case, your loan to value would end up at 85% because your loan amount was $640,000 divided by the market value of $750,000. At this stage, you can choose either to walk away from the offer if you are within the contingency period. However, if you waived all contingency rights, then you have only a few options. Number one, if you want to keep the loan to value at 80% to avoid paying mortgage insurance, then you would need to come in with an additional $50,000 as your down payment to close the loan. Number two, if you want to keep the same down payment of $160,000 and you want to keep the same loan amount for $640,000, that would put you at 85% loan to value. The lender will require additional private mortgage insurance be added to your mortgage payment. Now, side note, what is private mortgage insurance? This is insurance that protects the lender in case the borrower defaults on a loan. Typically, it is required on a conventional loan when you down less than 20%. When you complete your application for a refinance, the lender will run your application through Fannie and Freddie's automatic underwriting system. Fannie and Freddie, by the way, are two federal entities that set lending standards for the secondary market. The automatic underwriting system will evaluate your income, assets, liability, credit, and real estate owned details to evaluate the risks and will instantly let us know whether or not you need an appraisal for your refinance. Some pointers that I found that can really help qualify for an appraisal waiver would be, number one, if you have refinanced in the last maybe 5 to 6 years and previously completed an appraisal, they might not ask for another one now. Number two, stable long-term income. That really helps when they can automatically verify such employments like W-2 or retirement income. Third pointer, Self-employment income can still qualify, but it helps to have at least 3 to 6 months of the PITI mortgage payment in reserves for your assets listed on the application. Fourth pointer. In general, having assets in your reserves on your application for about 3 to 6 months of the PITI on your mortgage will help in all scenarios. When I say PITI, that stands for your principal and interest mortgage payment, plus your property taxes, plus your homeowner's insurance payments. Pointer number 5. Avoid listing rental income if you can. If you really need it to qualify, of course, you can use it. But if you can qualify with just W-2 income, I would avoid listing rental income on the application. And pointer number 6. It really helps to have a lower debt-to-income ratio and a good credit, of course. Additional tips for appraisals. When it comes to lending, please be prepared. The inspector will come out to assess the property's condition and make sure that it meets all building requirements as well. So it really helps to kind of be organized, clean up your house a little bit, make sure your home doesn't look like a construction zone. If you have any construction in progress, it may be wise to maybe wait until it's completed prior to applying for your refinance. Now, they usually won't be able to complete the assessment if you have any drywall torn out, kitchen cabinets missing, a giant hole in your backyard if you're planning to maybe add a swimming pool or an ADU unit. I would suggest waiting to do such construction. The inspector is looking to assess the market value of the home based on the property's description with the county. So keep in mind any unpermitted work like that kitchen you added in the back of the garage, or maybe that wall you closed out to make an extra bedroom. They may ask you to correct it and return the structure back into the permitted description, or they will not be able to complete the assessment. I would suggest maybe look around your property. If you yourself can see any visual damage, it might be a good idea to address it prior. Fixing anything such as, cracks in the foundations, any rotting wood, leaking roof, things like that would be usually required to make repairs prior to closing your loan. So save yourself the hassle, look around, make those repairs prior to getting your appraisal done. This is why usually when you're buying a fixer-upper home, they usually require all cash because the lenders usually want those repairs done prior to lending money on such a home. And of course, the obvious but common missed item that we see all the time is make sure you have your carbon monoxide detectors up. Also in California, water heaters must be double strapped and secured. If you have any questions or doubts about an appraisal, please reach out to us for help. And that has been your Fast Mortgage Insight. Thanks for watching. Don't forget to like, subscribe, and ring that bell to be notified for future releases. Bye now.